Hello guys, good evening. I think we've waited a bit. I think we can start. Welcome for today's webinar. Today's introduction to Forex. So you're going to start basically to learn about Forex, the fundamentals of Forex. As usual, as I say, you do have a disclaimer, which I entreat you all to pay attention to. Basically talks about um, knowing and acknowledging that Forex has some risks associated with it. So if you intend to be in it, you have to be aware of it and then seek the appropriate advice needed. With that said, we'll go on straight. The outline that we'll be looking at is we're going to define what Forex is. We're going to learn the major participants in the Forex market. We'll be looking at tools required to access the Forex market. We'll also be looking at what is traded on the Forex market, what makes Forex attractive, and then maybe I'll chip in some benefits as well, and then who a Forex broker is. Then we'll tackle factors to consider when choosing a Forex broker. We'll also go on to trading times and trading sessions in terms of Forex, like the times that the market is open for trading. And then we have some terminologies in Forex that I believe you need to get acquainted with. We also have currency pairs, like what they are. And then we have pips. That's a usual term that most Forex traders use. We'll also talk about that. We also learn what bid, ask, price, and spread are. We also learn what is lot size. We'll go through leverage and margin. We also know the type of trading orders, what is take profit and stop loss, trading plan, risk management, trading psychology. We'll go through a few mistakes that traders make, and then the forms of analysis. So to start off with, we'll move on straight to what is Forex. Now, basically, Forex is just a short form for foreign exchange. It is the most richest financial market we have in the world, but quite unfortunately, it's only a few that are earning from it. It's about 2% of the world's population that is earning from it. Now, all basically we do in Forex is buying and selling. You buy, you make money, you sell, you make money. That's basically what we do, buying and selling of currencies and other commodities. Now, currently, Forex trades over $6.6 trillion daily. Daily, I emphasize daily. So that's a lot of liquidity, a lot of money in Forex. And I have a diagram here which shows a comparison with the world's top stock exchange, the three most stock exchange. We have the New York, we have Tokyo, and then we have London. And those three, if you should look at the images, realize that they come nowhere near Forex, even if you combine the three. So that should tell you that there's a lot of money involved in Forex. And anyone who learns Forex and knows how to trade it has a potential of making some money out of it as well. We'll move on. If there, okay, as we go on, if there are any questions, you can type them or you can raise your hand and then I'll allow you to put the question across. So we go on to major participants in the Forex market. Now we have the governments and central banks in the Forex market. They are involved and usually it's to help their economy basically, to stabilize and to prevent their currency from depreciating. We also have financial institutions like banks, hedge funds, other investment companies. They are also involved in the Forex market. They have traders that trade the Forex market so that they can make some revenue and make some money for their clients and their bank itself. We also have forex companies. Now, these forex companies usually are mostly brokers. And as we go, we'll learn who brokers are and what they are about. Lastly, we have retailers, who is basically any individual that trades forex. So that's someone like you and I. We are the retailers, and we also are part, even though we don't have the majority of, or we don't take the majority tax in there. We are also a major player in the forex market. Now we move on to the next, the tools required to access forex market, and they are basically three simple tools. You need your computer or laptop or phone or tablet. You need internet. And then lastly, you need a trading platform. And this trading platform always is provided, or usually you have access to it by a broker, through a broker. So those are the things that you need. And apart from having the knowledge of knowing how to trade, these are actually the essential things that you need to be able to trade Forex. I'll tackle what is traded in the Forex market. The Forex market is not like any ordinary market where you buy and sell clothes. There are specific stuff that are traded in the Forex market. And mostly, or usually, let's say majority is currencies. And currencies are pegged against each other, which we'll also tackle that. So we trade currencies. We trade energy, which is oil, like an example, oil and gas. We trade metals such as gold, silver, platinum. We trade CFDs, such as stocks, indices, bonds. They are all traded on the Forex market. Commodities, such as even corn and wheat, are also traded in the Forex market. And then cryptocurrencies, such as Bitcoin and Ethereum and the rest. They are also traded on the Forex market. And dependent on the broker that you sign up with, you might get all or some of these stated here. So it's not like every broker has access to all. Some brokers don't have stocks, some don't have bonds, some don't have indices, some don't have commodities. So basically, depending on the broker that you sign up with, you get access to a combination of some of these, probably not all. Now, we'll move on to what makes Forex attractive. And then I'll probably chip in with the benefits of Forex. Now, we say Forex is attractive because of the large financial market, as we saw earlier. It's the biggest market in the world, biggest financial market in the world, trading over 6.6 billion daily, a trillion daily. Also, it is open 245. It's not 247, 245 like that. 24 hours a day from Monday to Friday. So it's open during that time. You can step in and trade. Even if you are working, you can choose to trade maybe after work or probably early morning before you go to work. You can just choose to enter your trades, go to work. When you come in the evening, you check and see the ones that made profit, those that failed, you analyze, and then you move on like that. And then it's available to everyone. Any individual can trade Forex market. And also it has high liquidity. Basically, when we say liquidity, it's money, like there's a lot of money involved. And then also it's not capital intensive. These days, because of brokers with as little as $20, $100, you can start trading the Forex market. Even though it's not advisable, usually if you ask anyone, especially those outside in the US, they'll tell you the minimum amount to start trading with is $10,000. But we here, this part of the world, can't usually afford that. So because of that, brokers have made it such a way that with as little as you start trading. And then also leverage. Leverage is something that we'll look at, but it's also something that makes it attractive. And then the low transaction costs. in terms of when you enter a trade, the charges that they charge for a trade is quite low. And also it's risk free in terms of there is a demo account, which for me, I entreat all my students, before you put in a dollar, a penny, make sure you trade on a demo quite consistently. Make sure on the demo you are making profit consistently. Challenge yourself. Be able to move, let's say, $100 to $1,000. Be able to move $1,000 to $10,000 on the demo account. Once you're able to do that on 3 consecutive times, then you have the confidence, and then you yourself, you'll be happy that yes, I've been able to make it with a demo account. So you're confident that if you put in your money, you're not going to lose everything. You're going to make profit out of that. So that's what makes attractive. I also add in chipping some few benefits. In terms of the benefits, like you can trade for yourself, you can make extra income for yourself when you trade a forex market. You can also work for a bank. I know a couple of my colleagues who, by just knowing the skill of how to trade without a degree, they have been employed by banks such as Cal Bank and Barclays Bank to be trading for them. So there's that opportunity also over there, especially if you're allowed on social media, and these bank people get to hear of you, and then they can get you signed up to trade for them, and they pay you. We also have, you can also work for a broker, because your trading activities is going on with a broker. So usually the brokers do analysis of their traders, and sometimes the good ones, they try to poach them to work for them. So that's also an opportunity. And you can also have work for funding companies. We have now, quite recently, there are a lot of funding companies coming up because they've realized there are a lot of traders that cannot have access to huge accounts. Like retail traders usually it's $100, and then here and there with a small capital. But we have funding companies who are ready to give you huge capital to trade, and then you split. And in my research quite recently, usually there are some in which there are a few rules that you have to follow though. But once you get signed up with a funding company, you trade, you make profit. What they do is they split the profit, either in some cases, at West, in some cases it's 50-50. You split the profit, but they put in the capital and you trade. And the losses, you don't bear the losses. The losses, they take care of it. But in terms of profit, you split. At the West is 50-50. In some cases, we have 70, where you, the trader, takes 70% and the company takes 30%. So there's that. And then also there's also the part of teaching, just like what TradingXpet is doing. You can teach individuals, charge a fee. You can also teach companies like banks. Banks can also recommend you to train their personnel and you charge a fee. So these are some of the benefits that you can also get from Forex, or having the skill of trading in Forex. Okay. So let me repeat again. If you have any question, you can type it in or alert me so that we deal with that as we go on. I'll move on to who is a forex broker. Now, a forex broker basically is a financial company, service company, that provides access to retail traders to the forex market. So they are more like mediators. Now, in terms of going back in the history, when Forex started, it was usually the top dogs, the elites, those who had the wherewithal to be able to enter. There were a lot of regulations on it in terms of your assets that you need to have, in terms of your financial capital that you need to have. It was very huge, and it was only the top dogs that were dealing with it. But fortunately for us, because of the internet, which made the world a global village, we also found a way to get in through forex brokers, because brokers, what they do is, since individual or retail traders did not have the huge amounts of money to be able to trade, it's like they are more like a crowd funding source. So they get all the traders, a lot of traders put together, then all the small amounts that you put in there now become, wait, I think Ruth has a hand raised. Let's see if we can allow her to ask a question. Ruth, you can ask your question.
Okay, good evening.
Good evening.
Please would like to ask about the aspect that relates to liquidity.
Okay.
How often can you withdraw your proceeds, and by what means? Do you do it through platforms like PayPal or foreign
Yes.
accounts?
Yes. In terms of deposit and withdrawals, it depends on the broker, but most brokers, what they give is you can use your Visa card, you can use your bank like direct wire transfer. You can use some allow PayPal, but it's not all of them. Even some allow Momo, but quite recently, I think the service provider for Momo in Africa is messing up, so they've stopped that. But they are looking for alternatives. So there are several. You can also use Bitcoin. There are several deposit and withdrawal. And in terms of how often you make profit, that's how often you can cash out with that.
Okay, so if I make profit, let's say every 3 days or daily, I can transfer the money directly from my Forex account to my local bank account here.
Exactly. Exactly.
Okay,
Yeah.
thank you. Well noted.
Okay. You're welcome. Okay. So yes, let's continue. So with brokers, that's the job of brokers. They allow us to be able to have access to the forex market. They also give us something called leverage, which we will look at in the coming slides. So some of the brokers I have listed here, the well-known ones. We have Exness, we have IC Market, XM, Hot Forex. There are quite a lot, but these ones are quite legit and reputable as well. Now, because of the internet too, in terms of um, forex brokers, there are some which are also out there to defraud people. So some companies were just created, they are wishy-washy companies just created to fraud people. So it's very important that you take note of the forex broker, have to study a little bit about them and know what forex broker is legit. I have on the next slide that will look at certain things to look at when choosing a forex broker so that you don't fall victim to any of these brokers which are out there to get your money. But these ones listed here, they are legit. They all have the required licenses and whatnot. And as we go on, I'll also give some recommended ones as well. Okay. So now factors to consider when choosing a broker. Number one is security. How secure is their platform? Well, those of us in the IT field, we look at things like SSL sets. It's basically when you look at the browser, when you type in the Forex Broker's website, usually on the left, the very left, there is this padlock. There, if you see that the padlock is locked, it shows that the site is secure. And in terms of when you're entering your, how do you call it, your credit card details, do they save it on their platform or they just use it for the transaction? Those are all included in security. So if you see that the padlock is locked, it's also showing that they are using a security protocol which does not allow them to save such details on their platform. So it makes them secure. Then we are looking at also regulation. You have to check if they have verifiable reference numbers on their website. And we have regulatory bodies like the Financial Conduct Authority, which is in the UK. We have the Cyprus SCC and a couple of other regulatory bodies. Almost every country has their regulatory body. In Ghana here, we also have the SEC as well. So even if Forex Broker is registered here, they should be able to have the requisite license from the SEC in Ghana. Then also we look at transaction cost. You have to compare and see their charges in terms of spread, which we also look at what spread is. Then in terms of deposit and withdrawal, they should have reliable and hassle-free methods of deposit and withdrawal, which are cool to you. So mostly Skrill, some use Bitcoin, some to allow PayPal, some to allow bank direct wire. Usually in terms of the bank direct, they say it takes like 3 to 5 days or so before it gets into your account. But once you make the withdrawal, you are sure that you get your money. Then also the trading platform. In terms of Forex traders, some prefer to use, we have several platforms which we'll also go through. Some prefer to use the MetaTrader, some also prefer to use the CTrader. These are the two main well-known, but there are other platforms as well. Some brokers have their own personal platforms, but you have to see if the platform is user-friendly before you also sign up, and if they have your preferred in terms of the MetaTrader, whether it's MT4, MT5, or they have both, you have to look at that. And then also customer service. They should have a quick, rapid response customer service structure so that they will answer all your issues that may arise that you may have. So these are the factors that you look at in choosing a forex broker. The key ones are basically regulation. You look to see if they are regulated. That's the key one. And usually most of them have their license numbers and registration numbers on their website. So you just go there. If it's with the FCC, you pick the number, you go to the FCA website, you check to see if their details are there to show that they are regulated. Then you can know that, okay, yes, this is regulated by the FCA, so I can be able to do business with them. Now we'll carry on. We'll look at, so we are looking at trading sessions. We have Sydney, we have Tokyo, we have London, Frankfurt, New York. And each of them has the time that it opens and the time that it closes. Usually each session takes 9 hours. So the Sydney session moves from 9 p.m. It opens from 9 p.m. to 6 a.m. GMT. Tokyo opens 11 p.m. to 8 a.m. Yes, Frankfurt session opens from 8 a.m. to 5 p.m. And New York session opens from 1 p.m. to 10 p.m. GMT. Usually, the most, like the 3 main sessions that we forex traders consider. You see, from the way the sliders have tried to give them different color codes, and it's in 3 major forms. So the Sydney and Tokyo sessions are lumped together, so as one. So usually we look at it as one. And then we have the London and Frankfurt session are also looked at as one. So we call it the London session. And then we have the New York session also as one. So the 3 major sessions that we look at are the Tokyo put together with Sydney, London and Frankfurt together, and then New York. Now, in terms of trading, the best advice that traders have to take is they have to trade when 2 or more sessions are open. So during the time that 2 or more sessions are open, that's when you trade. That's when you look into the market, you enter your trade. The reason being that is during those times that there's volatility. And when we say volatility, what we mean is that the rate at which price changes. And it's volatility that makes us money, or it's liquidity that makes us money. So if you're trading during the time that the market is quiet, there's no movement, there's no rate of change of price, you're not going to make any money. But during the time that 2 or more sessions are open, there are a lot of trading going on, so there's volatility. So that's when you can also enter, and then in the shortest possible time, you can make some money. So it's always advisable to trade when 2 or more sessions are open. And that's one major thing that traders will have to consider. We'll move on. Now, terminologies. The terminologies that we have in Forex. There are quite some terminologies that we use to confuse our friends. I think in any profession that we have, there are a few terminologies that are used. So in Forex, when we say to go long, or when we say go long, it just simply means to buy. When we say go short, it means to sell. So short means sell and long means buy. Then we also have trending market. Trending market means the market is moving in a specific direction. We have ranging market. Ranging market means the market is moving sideways. It means it's neither going up or down. It's moving sideways. But trending market has a specific direction. It's either going up or it's coming down. Now we have a bullish market. Bullish market is a trending market because the market is going up. But when we say bullish market, it means the market is going up. When we say bearish market, the market is going down. Now, basically, these names are from, if you look at the two animals, bull and then the bear, how they attack their prey. That's how these names came about. A bull, when attacking his prey, uses the, how do you call it, the horns to hit its prey up. So that's why bull market means it's going up. And then the bear tries to push its prey down, like to attack him, hitting on the chest and pushing it down to be on him. So that's bear market is going down. So these are this is what made us coin out these names and these terms. So when we say bullish, it means it's going up. Bearish, coming down. Bull means buyers. That means those who are buying. Bears means sellers, those who are selling. And then we have the term hawkish. Usually, the term hawkish is used for central governors, the central bank's governor. Like, let's say in London, the central bank governor is hawkish. When we say he's hawkish, it means he's likely to increase interest rate. Someone who is in favor of increasing interest rate, like any government personnel who is in favor of increasing interest rate, we say is hawkish. And dovish is the opposite, someone who is more likely to reduce. And we have the term NFP, and which is non-farm payroll. It's also a very important news event in the US. It comes up every first Friday of a month, and it's something that traders pay attention to make a lot of money within the shortest possible time. Because when the news hits, it talks about it gives the unemployment rate in the US, comparing month-to-month basis, and it also tells about the job gains each month. So such information is used by traders. The reason being, if there are more jobs added compared to a previous month, it means more people are getting money. And if more people are getting money, there's a lot of economic activity that is going to go on. So it means the US currency is going to be strong. And if the US currency is going to be strong in the forex market, since we trade with pairs, you know that the US dollar is strong, so you try to always buy that currency, and that's what we do in the forex market using this news, NFP news. And also the currency pairs do have their nicknames. They do have their nicknames. The US dollar is called the greenback. The pound is called cable. The New Zealand dollar is called Kiwi. The Australian dollar is called Aussie. Canadian dollar is called Loonie. And oil is called black gold. So these are nicknames given to these pairs as well. So basically, that is the terminologies used. These are a few of them. I think most of them, usually, these are the main ones is to go long, short, trending market, ranging market, bullish, bearish, understanding what it means, bulls, bears, and hawkish and dovish. That's if you pay attention to the news event. That's those ones. Now the next thing to look at are currency pairs. Now there are quite a number of currency pairs in the world. And basically how currency pairs are named or are written is usually they use the first two letters for the country name and then the last letter for the currency of that country. There are some exceptions though, but generally That's how it's supposed to be. So you have the euro, you have the US dollar, you have the Great British pounds, you have the Swiss franc, which is also an exception because of how it is. We have the New Zealand dollar, Australian dollar, Canadian dollar, Japanese yen, and then the Chinese yuan. These are some of the currency pairs. We also have Ghana cedi, but unfortunately for us, Ghana cedi is not usually traded on the forex market. So I think in Africa, the one that is traded is the South African. That's the South African rand. Sorry, that's the pair that is traded on the forex market. So that's how these the letters are formed. They are 333, but the first two is for usually for the country, and then the last one is for the country's currency. Now forex is traded in pairs, so we peg the pairs together. One interesting thing is that when you are selling a pair, you are at the same time buying the other side of it. So let's say if you want to sell Euro USD, when you are selling Euro, what you are doing is you are actually buying dollar at the same time. That's how it means. So once you are selling the other, you are buying the other. That's how. That's why it's put together in pairs. So currencies are traded in pairs. So some example of the pairs we have the Euro USD, which is the Euro and then the US dollar put together. We have the USD CHF, which is USD and then the Swiss franc. Sorry, we have the Great British pounds and the Australian dollar paired together. So these are some of the currency pairs that we trade. Now, the first one that comes, we call it the base currency. It's a base currency because it's always a unit of that currency. And then the second one that follow is what we call the quote currency because you are going to quote the price in that currency. So if you say Euro USD and we give it a quote, let's say 1.130, what we're actually saying is that you need 1.1302 US dollars to get 1 euro. So the first pair that comes, the first currency that comes, is always in single units, like 1. So if you're saying USD CHF and the quote is, let's say, 1.0, what you are doing is you are saying for each US dollar, you need 1.0 Swedish franc to get it. So that's how it is quoted. So we have the base currency, which is the first one, is usually the first one and always is in units. And then we have the quote currency, which determines the amount or the quantity of that currency that is needed to get a single unit of the base currency. Excuse me. So that is how currency pairs are paired in the forex market, and that's what we call currency pairs. So any pair that you see, the very first 3 letters, which is the first currency, is always in single units, 1. The ones that follow tells you the price of it, like a single unit, the price of it in the other currency. So we have the base and then the quote currency. That is that. Then we'll move on to what is pips. Now, pips is quite a term that is used mostly by forex traders. The full rendition for pips is points in percentage. Basically, what it means is the smallest unit of change in a currency pair. Now, most currency pairs are quoted with 4 decimal places. Most of them, with the exception of a few, and we'll look at that. The few ones are in terms of the Japanese yen pairs. Those ones are quoted with 2 decimal places. And then gold is also an exception, which is quoted in 2 decimal places. And their pip calculation is also different. Just as I have here in this diagram, we have Euro USD. Usually, these pairs, like these currency pairs, have 4 decimal place, and the last decimal place of it tells the pip movement. So if a currency move from, let's say, 1.1050 to 1.1051, that is 1 pip move in terms of when you're talking of Euro USD. So it's the 4th decimal place of the currency pair. If it changes, that's what calculates pips. So if you want a 10 pip move in Euro USD, it means if the price is at, let's say, 1.1050, if you want it to move 10 pips, it has to move to 1.1060. That will be 10 pips. Now, when it comes to USD JPY, it has 2 decimal places, and the pip move is the 2nd decimal place. So if it moves 1 pip from, let's say, 100.50 to 100.51, that is 1 pip move. If you want it to move 10 pips, it means it has to go from 100.50 to 100.60. That's 10 pips. And then gold is quite funny. Its pip move is also different. Now, gold, the 1 pip of gold starts on the, let's say, it's 1 decimal place. You start calculating on only 1 decimal place. You don't go 2 decimal places. Now, some forex brokers, instead of quoting 4, will quote 5. Irrespective of the number of decimal places, if it's 5, you just ignore the 5th one and then you stick to the 4th one. If it's 3, instead of 2, you ignore the 3rd one and then you concentrate on the 2nd one. When it comes to the Japanese yen pairs, usually it's only the Japanese yen pairs that have the 2, and then gold that have the 2, but the rest is usually 4. And pips is used to calculate the rate of change in price, like the change in price, and that's what makes us money. So if a trader tells you he made 100 pips, it means he made, if it's, let's say, in Euro USD, he says he made 100 pips. It means the price, if the price is from 1.1050, 100 pips will mean that the price moved from 1.1150. So that's basically a change in price, and that's the smallest unit in which we calculate the change in price in forex. The 5th one is usually called points or pipette, but when the forex brokers, those who have the 5 and 3, we don't usually concentrate on the last ones. We ignore, and then we use the 4 decimal place for the Euro USD and the other pairs, and then the JPY pairs, we use the 2 decimal place for them. So that's pip. And there are a lot of calculations that is done on this, but usually it's good you know how to calculate pip. So just as I explained, you can also calculate if, let's say, Euro USD, if, let's say, move from 1.1000 to 1.1100, you can identify the number of pips you move. But on the Forex Brokers platform, there are tools that you can use to measure pips as well. But it's good you know it offhand so that you can also do it by yourself. So that is pips. We'll move on to the bid ask price and then spread. Now, when we say bid is the price that a forex trader will sell a currency pair. So if you want to sell a currency pair, let's say per your analysis, you've realized that the currency pair is going to go down, so you want to sell it. When you click the sell button, it will activate using the bid price in the market for you. So that's why we say the bid price is the price at which a forex trader will sell a currency pair. And then we have the ask price. The ask price is the price at which a forex trader will buy a currency pair at. So always when you look at the currency pairs, we have the bid and ask price. There are two prices. One is used when you want to sell. One is used when you want to buy. Now, usually, the ask price is bigger than the bid price. And the difference between the ask and the bid price is what we call spread. So when we say spread, it's just the difference between the ask and the bid price. Now, why is there a difference? The spread is usually what the forex brokers, that's their fee. Usually that's their fee. When you enter a trade, that's what they take. So the spread is for them. With forex brokers, it's basically the difference between the bid and ask price. That's the spread, and that's what makes them money. Yes, so that's about ask and bid price, and then what spread is. Now we'll move on to what we call lot size. Now we have three or four, let's say three major main types, but there are four. But there are three main types of lot size. Now, someone may ask, what is lot size? Let's take a scenario like we have three traders. Now, these traders deal in jeans. They go to, let's say, China to get jeans, and then they come and sell. Now, when they go, they don't just go to buy a single jeans and then they come and then they sell it. They buy it in bundles. So those bundles that they buy is what we call lot size in Forex. So we have standard lot size, we have the mini lot size, and we have the micro lot size in Forex. And the standard lot size means 100,000 units of a specific currency. So if you want to buy Euro USD at a standard lot price, it means you are buying it at 100,000 units of it. And if you want to, if you want to buy it at a mini lot, you're buying 10,000 units of it. If you want to buy it at a micro lot, you're buying 1,000 units of it. And these lot sizes are represented on the trading platform. Usually for the standard lot is 1.0, that's 1. And then the mini lot is 0.1. And the micro lot is 0.01. So when you're trading on the platform, the lot size that you use. And the lot size also determines the amount of money you are risking or you are earning. So the standard lot size means each pip is $10. So if a trader says he used a standard lot size and he got 100 pips, that means 100 times 10. That's his profit he made in dollars, 100 times 10, which is $1,000. So 100 pips using the standard lot is $1,000. Now, if you use the mini lot, which is 0.1, it means each pip is $1. So if you made 100 pips, it's 1 times 100, which is $100. And then the micro lots, 1,000, which is 1,000 units, which is represented by 0.01. And it means each pip is like 10 cents. So if you made 100 pips, that's like $10. So depending on the lot size that you use, it will determine the amount of money you are risking or you are earning. So usually it depends on your account size. If you have a big account size, you can go in big, get the big sums of money. So it's just like in the three traders scenario. If one trader buys a standard lot of jeans and comes to sell, he's going to make more money than the one who bought the mini lot of jeans to sell. That range. We also have the nano lot, but that one, most brokers, it's only a few brokers that use the nano lot, which is 0.001. Usually the minimum you find is the micro lot, which is 0.01. So that's lot size. So anytime you're trading, you need to use a lot size. If you want to enter a trade, you need a lot size to use. And the lot size to use must be in accordance with your account size or your account balance. So that's start with lot size. Now we look at something called leverage. Leverage, usually the textbook definition of leverage is the ability to control a large sum of money using very little money. So what leverage is that It's something that brokers gives us. Now they make it able for us to control large sums of money in the market. We using our small deposits. So let's say when you're creating your account with a broker, you also have to define the leverage that you want to consume. Some brokers have as much as 1 to 1,000, 1 to 2,000, 1 to 50, 1 to 100. Now, what it's telling you is that for each dollar that you are putting in, if the leverage that you are choosing is, let's say, 1 to 1,000, it means for each dollar that you are putting in there, it can control $1,000 of it, like 1,000 times. It multiplies your money by that leverage number. So if it's 1 to 50, means the money you're putting in there can control an amount 50 times your money. If it's 1 to 100, it means the money you're putting in can control 100 times. So that is leverage. So leverage allows you to control huge sums of money. Now, leverage is a double-edged sword, I always say. It allows you to control huge sums of money, but it also allows you to lose huge sums of money. So you should know the type of leverage you should use as per the amount of money that you are putting in there, which will also give some recommendations as we go on how that is. Now, margin is more like a collateral. If you want to make a trade, you need to put in a collateral to make the trade. So it's more like the amount of money that you put in there, which usually the broker will reserve. So out of the money you have in there, any trade that you make, the broker reserves some amount of it just to hold that trade. And once that trade is done, the money is returned into your account. So it's just more like an equity, or let's say, yeah, a collateral. So that is margin. Now, there is this calculation about leverage and margin and lot size. And usually margin, you say margin is equals to lot size over leverage. So if you want to know the margin that is required, usually it's done automatically on the trading platform. But if you're a bit inquisitive and you want to know how that amount was calculated, you know that margin is lot size over leverage. So the leverage that you choose and the lot size that you choose, if you divide the leverage by the lot size, you know the margin in terms of the dollar value that the broker is going to hold for that particular trade. Now move on to type of trading orders. Now there are basically three main types of trading orders, even though there are quite some more, but um, the trading orders we have or we basically use, we have the instant market execution as one order. We have the stop orders and we have the limit orders. Now, what is instant market execution order? It's basically when you want to buy and sell and you hit buy sell straight away. That is instant market execution. So you're just using the current available instant price to make the trade, whether when you're buying or selling. That's instant market execution. Now we have stop orders, we have limit orders. Now these two are telling the market or telling your broker that you want to buy or sell a currency pair at a future price. At a future price. Now, when we talk of stop orders, we have two types. We have the buy and then the sell. The buy stop order means that you are placing the order above current price and you expect price to further go up once your order is activated. That's the buy stop. So let's say you realize that Euro USD is going to shoot to the moon. You put your buy stop order way above current price. So let's say current price is around 5. You put your order, let's say at 6, and you expect price to even go further up to 10. So that's the buy stop order. You put it above current price and you expect it to still shoot up. Now the sell stop is the opposite of the buy stop. Now when you put a stop or you put a sell order way below current price, you expect, let's say, Euro USD to fall. So you put it way below the current price and you expect it to go further down when your order is activated. Now the limit orders is also the opposite of it. When we say buy limit order, you expect price to go down at a point, and when you get to that point, you expect it to reverse. That's the buy limit. So you put your order below current price level, but you expect price to go down to hit it and then change direction and go upwards, making you more money. That is the buy limit. Now the sell limit too is the opposite of that. You put it way above current price and you expect price to go activate your order at that high level and then reverse to the downside. So these are the orders, and we'll go through how to set those orders once we get into the practical aspect on the platforms, the trading platforms itself. Sorry. So we'll move on. The next thing that we'll look at is take profit and stop loss. These two are very essential for each trade. Now the big question is, when do you buy and when do you sell? Basically, you buy when, based on your analysis and your anticipation, you realize that price of a currency pair is going to go up in value. That's when you buy. So you realize, let's say price is at 10, and per your analysis, you realize that it's going to even go up to 100. That's when you buy. When do you sell? You sell when, based on your analysis, you anticipate that price is going to go down. So, for example, if price is at 10, you realize it's going to go down to 1, you sell. So those are the main reason why we buy and sell. Now, when we are buying and selling, it's always advisable, which we'll look at when we get to risk management, to have a stop loss and a take profit. Now, a stop loss is an order, it's also an order, a type of order that is placed on the trade. Now, what you are telling the broker when you place the stop loss is that this is the amount I'm really willing to risk on this trade. If the trade is not going in my favor and it's reversing against me, when you get to this point, close it so that I don't lose further more on my money. So that is what stop loss is. You are telling the broker that stop my loss. I don't want to inquire more loss. So at this point, that's where I'm risking this amount. At this point, when it gets there, stop the order, and automatically the broker will do that. Take profit is the reverse. You are telling the broker that the trade is going in your favor, you're making money, but when it gets to this point, close the trade and secure my profit. Basically, these orders are there to help us so that we are not always stuck on the screen looking at our trades. You can place your trade once you set your stop loss and take profit. You've accepted the risk that if it goes against me, it should stop at this point. If it goes in my favor, at this point, I should secure profit. So you can close your laptop, close your phone, and go and do something else. Once anyone gets hit, automatically the trade is closed, and then if its profit is added into your account, if it's lost, it's also deducted from your account. So these are fail-safe. In terms of the stop loss, it's a fail-safe that you tell the broker that for each trade or for this trade, I'm willing to risk this much. So that is that. Now, in terms of the placement, when you are selling, the stop loss is placed above. So let's look at this image over here. When you are selling, you put a stop loss above because you expect price to go down. You expect price to go down when you are selling. So you put your stop loss above your entry where you made the sell. Why? It's because you are telling the broker that I want to sell, but if it's going against me, when it gets to this point, close the trade. I don't want to lose all of my money. I just want to lose only this amount when it goes against me. Take profit. You are telling the broker that, yes, I'm selling and it's going in my favor, but when it gets to this point, secure my profit and add a profit into my account. When you are buying, it's the reverse. When you're buying, your entry is here, your stop loss is below because you're telling the broker that you are buying, you want price to go up. And then your take profit is way above your entry. So these are the two orders that we have: stop loss and take profit. Okay, now we move on to the next. That's a trading plan. Now, every Forex trader needs a trading plan. It's something that you need to set, or you need to have, and these are basically rules that you want to abide by in trading. It helps a lot. Trading plan, it helps a lot. I tell everyone that anyone who wants to trade should have a trading plan. And it's basically an organized approach to executing a trading system that you have developed, including risk management and personal psychology. And I have an example here of how a trading plan, someone may go about his trading plan. Will be like, I would want to earn 100% of my profits, 100% of my account in a month. So that's a plan. You put these steps in your plan. You want to make 25% of your money within a week. So you are planning for the trade. So you can split then further to each day how much money you want to make. And when you make that money, you stop trading daily. So let's say if your daily profit in your trading plan is $100, no matter what happens, if you make your $100, you just close and then you're off or you're done for the day. If it's $20, if you make $20 the day, you're done for the day. So it's a plan to guide you in terms of your risk. And your trading plan must also contain what we call your trading system or your trading strategy, which we also look at in the coming days. So what is listed here is usually some of the points that is placed in a trading plan. And I treat everyone to have a trading plan and also have a trading system so that you abide by it. It helps because in Forex you need discipline, you need patience, and you need a lot of how do you call it? You need a lot of discipline and a plan. When you follow a plan, you are a bit disciplined in trading, and it helps a lot so that you gain consistency in trading. Next is risk management. Now, in terms of risk management, you have to manage your risk because there's risk involved in trading. And if you're a good risk manager in Forex, you can do well. You can do very well in Forex. Like I said the other time, you don't borrow money to trade because it has a whole different psychology to deal with. And I usually call it scared money. You don't trade with scared money because you are already scared to lose that money because you borrowed it. And when you bring that money into Forex, your whole psychology will be messed up. So in terms of risk management, we have money management. I have separated them into money management and trade management. In terms of money management, don't borrow to trade. And then also, you are not supposed to risk more than 3%. Usually, advisably, you have to use 1% for each single trade. So if your account size is $100, make sure you're not risking more than, you're saying 3%, that is like, let's say $3. But ideally, you should not be risking more than 1%, which is, let's say, $1 on each trade, that you take. And if you follow this risk management religiously, it will help you to preserve your money and to be consistent. Otherwise, you end up blowing your account, and you feel very bad. So this is where knowing margin, what margin is, knowing how to calculate your pips is very important because it helps you to know the amount you have to risk. And if the amount is in is in parallel with your risk management, which is let's say 3%, then you can go ahead to trade. And then you have to use the appropriate lot size. Like we said, if you use a standard lot size on a $100 account, you're just going to blow it because one pip is $10. So if you move 10 pips, your account is done. So in terms of the lot size, it's very important to use the appropriate lot size for your account size. And then always use a stop loss. That is very important because stop loss helps you to prevent unnecessary loss of capital. And then do not over leverage your account. As we know, leverage helps you to, it helps you, it's more like you're using borrowed money. It helps you to gain more, but it also can also let you lose more. So use the appropriate leverage for the account size that you have. Now, when it comes to trade management, we'll also look at what is risk to reward ratio. It's basically telling you that when you're risking, let's say, $10 on a trade, it means your stop loss is at $10. Like it's at a price which means that if you should lose, you're losing $10. Your take profit should be at a higher point. So that's the risk to reward ratio. We have 1-to-1, which means if you are risking $10, you want to take profit at $10. If you use 1-to-2 or 1-to-3, it means if you are risking $10, you want to make $20. The 1-to-3, if you are risking $10, you want to make $30. Like those are the risk to reward ratio. And ideally, you should shoot for more, but usually what we do is when we enter a trade, is either we use a lot size, it's either we enter multiple times, setting take profits at different risk to reward ratios. So let's say if I want to enter a trade on EURUSD, what I'll do is I'll enter it 3 times. The first trade will have a risk to reward ratio of 1-to-1. The second trade will be 1-to-2, and the third trade will be 1-to-3. And if I enter 4 times, it means the fourth one, I'll just leave it open so that it can fetch more when it passes the 1-to-3 level. So you can have that as well. And then we call something called trailing stop loss. Now, trailing stop loss means once you are in a trade and the trade is moving in your favor, don't just look at it just like that. You set your stop loss all right. You're telling the broker that at this point, if it's going against me, close the trade. But now the trade is going in your favor. What you do is always, that's why we are saying a good trader is a good risk manager. Once the trade is going in your favor, you can change your stop loss. Now, what we usually do is we change it and put it in profit. So we put it at a point where it's in profit. So even if the trade should change direction and go against you, you're not going to lose nothing. You're rather going to make money. So as the trade is going in your favor, we trail our stop loss. We shift our stop loss into profit as and when the trade is going far in our favor. You have to also adopt that strategy of trailing stop loss, pushing it up, 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 up. As it gets in profit, you push it up. And then also setting clear take profit targets. Some traders don't set take profit targets. They leave it to run. Now, here lies the case. You not always be on your phone or on the computer looking at your trades. So it's good to always set take profit targets. Because if you leave it open, it can rise to a very good level. Let's say if you bought EURUSD, it can rise and you can be in profit, let's say 100 pips. Now, if you're not by your phone to take profit and you've not set take profit, before you realize it's reversed and it's gone to hit your stop loss. That is even if you set one. If you didn't set one, then your account is doomed. So always have take profit targets so that no matter where you are, if you're not behind your phone, when it gets there, you secure profit and you move on. So have clear targets for take profits so that you can secure profit as the trade goes in your favor. And we have something what we call scaling in, which practically, I'll take you guys through how to scale in your positions. If it's moving in your favor, you can add more trades to it so that you get more money. And then as much as possible, we have something called correlation, like correlated pairs. There are some currency pairs that move similar. They go similarly together. So as much as possible, refrain from trading such pairs. Why are we saying that? Is because if, let's say, Euro USD and GPB USD, they are correlated. They move likely the same. Now, if you should enter those two pairs, what you are doing is you are doubling your risk. If it's going against you on one, it's also going to go against you on the other. So always try to refrain from trading correlated pairs. So that is risk management. That these are a little bit, and if you are good at this, if you take this at heart and you practice it religiously, you can make consistent improvements in trading. Now the next thing we're going to look at is trading psychology. I always say any forex trader is also someone who actually is shaping his life, his or her life, because forex can put you in a whole different space. Now, one thing I always tell people is to know that the market will always be there. So you don't need to kill yourself trying to find trades in a certain day. If you're not getting any trade in a day, just close your laptop, close your phone, do something else. Another day, the market will be open. The market has been there since the 1970s. It's not going anywhere. So if in a single day you're not getting any trade, don't kill yourself. As my Nigerian folks would say, I can't kill myself. So that is it. Make sure that your mind is made up for the market. Analyze the market. Set your targets. If it gets there, you execute your trade. If it doesn't get there, you wait. Patience is key. So I have patience in here in terms of the trading psychology. And also, you do not need to trade with emotions. Always, like I said, have a trading plan. Trading plan, have a trading system or a trading strategy. Trading system or strategy are basically a set of rules that you look for before you take a trade. So that's a trading system, a set of rules that you look for. Let's say you want price to get to a certain point and you want to see a certain kind of candlestick before you enter. These are rules. So have them down and follow it religiously. That's trading without emotions. And then also there's also the element of greed. Greed will make you overtrade. So don't be greedy. Enter the market, set your targets. Don't try to capture every single pip in the market. You can't. No one can do that. You can never capture every single pip. So just set your targets. When you get it, that's why you need a trading plan. Set your daily limit. Let's say in a day, the maximum amount I want to get is $20. The maximum I want to get daily is $100. You set it. Once you get it, you are done. Don't try to look for extra trades in a day. Don't be greedy. And greediness will make you use insane lot size. Like in the scenario I mentioned, if you have $100 account, never use the one standard lot. Because a standard lot, if it moves one pip, is $10. So 10 pips, your account is done. And in Forex, 10 pips is just it's just 10 pips can happen in 5 seconds. So if your account is $100, never use a standard lot because 10 pips, you are done. And that is greedy. If you are greedy, you want to make so much money, but you're not thinking of the risk factor because you can also lose so much money in terms of the lot size that you use. And then we also have fear. Now, if you fear to lose money, I always say Forex is not yours. Because even the best traders in this game always have losses. So you'd always have a loss. That's why you need the risk management. Know that you are risking a certain amount of your money. What you are telling the market to do is either take my stop loss or give me my take profit. So once you've accepted that you are risking this amount, you can either lose or gain. And when you lose a trade, it doesn't mean you're not a good trader. Every trader has losses. Even the best and the richest traders, they all have losses. But the main key is risk management and using your risk reward ratio. As we go along, I'll do some certain mathematics with you that if you have a good risk to reward ratio, like let's say 1 to 3, you can lose majority of your trade but still be profitable. That's the risk to reward ratio. Let's say you take 10 trades. If your risk to reward ratio is, let's say, 1 is to, if it's 1 is to 3, it means for, if you lose, if you lose 3 trades, let's say if you lose 6 trades and you made profit on 4 trades, you are way profitable. Even if you should lose 7 trades and you made profit on 3 trades, you can still be profitable with that. So your risk to reward is also important. And then the last bit I want to stress on is patience. Patience, patience, patience. Allow your trade to run. Some trades can take several days to mature. Once you enter the market, sometimes the volatility will not be there. It will take several days before it comes. But once you've accepted the risk that I'm taking this trade, allow it to run. Don't be impatient and close the trade. Because before you know it, it can take 5 days and it will hit your take profit and you make money. So be patient with the market. Once you enter, allow it to run. And basically that's based on following your strategy. So that is that on in terms of trading psychology. The last bit I want us to look at for today, because it's time is getting fast, is some common mistakes made by traders. There are a lot of mistakes traders make, and off the top you have not having a trading plan. It is a big mistake. And then also not keeping a trading journal. A trading journal is basically recording the trades you take. So let's say you take a trade on Euro USD today. You record the date, the pair that you are trading, reasons why you enter that trade, where your stop loss is, where your take profit is. Each trade documents it. Now at a later time you can come back to analyze it and see the trades that did well, those that didn't go well. And then you can also identify why these trades went well and why these didn't go well. And then you stick to the ones that works for you. So that's why you need to keep a trading journal. And then also some mistakes they make is they use several strategies. There are several strategies to use, but always pick a strategy that you feel comfortable with. Try it, test it, make sure it works before you trade with it. And when you're trading with it, you stick to that strategy until it's not working anymore before you can switch to a different strategy. And then also, if you don't apply, some traders don't apply risk management. Some trade with insane lots just because they want to make money quick. Forex is not a get rich scheme, get rich quick scheme. It's a gradual process. You can make money gradually. So don't be using insane lots, risking your whole account on a trade. And then if you have a poor trading psychology, that is also some common mistakes they make. If you have a poor trading psychology, you'll be trading with emotions. And that is not good. You end up blowing your account. And also the bit I want to stress is also paying attention to news events. Sometimes you may analyze the market. Your analysis may go well, but then if you don't check out for news events, before you realize Trump has said something and your trade is going the other way. It used to happen to us last year during the time that Trump was president. He can tweet a single tweet and then the whole market will go haywire. All your analysis will be bogus and then it will go against you and you lose a lot of money. So you also have to pay attention to the news. So we'll look at some news portals that we traders check for news. And that bit is in, we'll look at those bits later. It's also in terms of the analysis, type of analysis you make on the forex market. So with that said, I think we've gone through a lot today. So I'd like to end here. Okay, so thanks guys. We're going to end today's session